The Swiss National Bank and the Covid-19 crisis. Welcome to this short talk in which I analyze the Swiss National Bank's response to the Covid-19 crisis. My name is Fabio Canetg and I'm a PhD student at the University of Bern, a teaching assistant at the study center Gerstensee, and a journalist at swissinfo.ch. Yesterday, when I uploaded the original version of that talk, I received a couple of comments from various people, some room for improvement, and therefore I just decided to re-record the entire talk and upload it again to YouTube, which basically just throw away 200 views that I had on the original video and upload a new one, starting off at 0 again, but that's just the deal. What I want to do, the leading question of this talk is, how did the Swiss National Bank respond to the Covid-19 crisis? And what I want to do is I want to analyze 3 policy measures. And the first one is the US dollar liquidity swap arrangements with the Federal Reserve Bank. Second, the exemption threshold policies, they're related to the negative interest rate policies of the Swiss National Bank. And third, the liquidity program for the non-financial sector. First, the US dollar liquidity swap arrangements. So what was the deal? To understand why the Swiss National Bank had swap agreements with the Federal Reserve Bank in the US, we have to take a step back first and understand what was happening in the beginning of the crisis. So in the beginning of the crisis, everyone was selling everything. Commercial banks and hedge funds and investors, everyone was selling everything to get their hands on US dollar electronic cash. And they were actually even selling US treasuries, which was a bit weird because US treasuries were regarded previously as the safest asset in the world. And they were selling US treasuries, which put upward pressure on the yields on US treasuries during a time when the Federal Reserve Bank was lowering interest rates. So that was a pretty weird market. That was pretty big market turmoil at the time. That was mid-March, something like mid-March. And the Federal Reserve Bank wanted to make sure that everyone could get US dollars electronic cash if they wanted to without selling US treasuries. That wasn't so easy because they wanted to get every single bank or hedge fund or investors to get their hands on US dollar liquidity, even if they were not in the United States. So think of a small commercial bank in Switzerland. If they don't have a bank account at the New York Fed. So it's not so easy for the Federal Reserve to tunnel US dollars to that small Swiss commercial bank. So what they did is they set up these arrangements with other central banks where the agreement basically was to swap currencies. So the Swiss National Bank gave Swiss franc electronic cash to the Fed, and the Fed returned US dollar electronic cash to the Swiss National Bank. And then what the Swiss National Bank could do was repo operations with that US dollar liquidity it had with Swiss commercial banks, the small commercial banks that I just mentioned in the beginning. And then the Swiss commercial bank that I mentioned would be afloat with US dollar liquidity without selling US treasuries. So that was the basic idea of these swap arrangements. The Swiss National Bank provided better conditions on the repo operations, the US dollar repo operations to the Swiss money market. They lowered interest rates, they offered US dollar at longer maturities and at higher frequency. Let's look at the details of this program. So prior to March, even prior to March 2020, the SNB offered US dollar liquidity on a weekly basis with a 7-day maturity at this very interest rate here, the US dollar overnight index swap plus 50 basis points. But no one cared. No one was demanding any US dollars from this facility. But then suddenly everyone wants to get US dollars and they demanded US dollar liquidity at these US dollar repo operations of the Swiss National Bank. And they changed the conditions on these repo operations on March 15th and March 20th. So now the interest rate is only the US dollar OAS plus 25 basis points, lower interest rates. The agreements have a longer maturity, 84 days instead of just 7 days that they're offered weekly with an 84-day maturity. And the 7-day maturity offerings occur daily now, not just weekly. So that was the US dollar liquidity swap arrangements and the US dollar repo operations by the Swiss National Bank that ensured that even small Swiss commercial banks were afloat with US dollar liquidity, and that basically fixed the US Treasury market. Let me move on to the second policy interventions by the Swiss National Bank, and this one concerns the exemption threshold. To understand what the exemption threshold is, we have to first understand what a tiered remuneration system is. And the tiered remuneration system that was introduced when the Swiss National Bank first introduced negative interest rates in 2014, 2015. So the basic idea is that the Swiss National Bank is charging negative interest rate on commercial bank reserves, on the liquidity that commercial banks hold at the Swiss National Bank. But the thing is, they're not charging a negative interest rate on the entire chunk of liquidity, but only on the liquidity which exceeds the so-called exemption threshold. And the exemption threshold is bank specific, is equal to the minimum reserve requirement times the threshold factor. We have to understand two basic concepts here because we're going to need them later: the marginal interest rate and the average interest rate. So the marginal interest rate for a high liquidity bank, for a bank which holds more liquidity than the exemption threshold, is minus 0.75%. That's the interest rate target of the Swiss National Bank, and that's actually the relevant interest rate for money market rates. For a low liquidity bank, the marginal interest rate is 0. So for a bank which holds very little liquidity, less than the exemption threshold, the marginal interest rate is 0. We will see that just shortly graphically. And importantly, the average interest rate, that's just the weighted sum of the two components. So it lies between minus 0.75% and 0%. We will see that just now. So graphically, this is a photo from one of my videos from my video blog that I had a couple of weeks ago. I uploaded them on YouTube, and this is an episode on the tiered remuneration system of the Swiss National Bank. Go check it out if you like. Give me some feedback, whether you like it or not, if you have some comments for improvement. So back to the tiered remuneration system. So here we have a glass, the jar, and the jar itself is the bank. The blue thing inside is the liquidity of the bank. And then the gray line here is the exemption threshold. So what you can see is that the bank pays a negative interest rate of minus 0.75% only on the liquidity which exceeds the exemption threshold. So only on this part here. On all the liquidity it has below the exemption threshold, it pays 0 interest rate. The marginal interest rate is the interest rate that is charged on the surface of the liquidity. So in this case here, this is a high liquidity bank with more liquidity than the exemption threshold. The marginal liquidity is minus 0.75% here on the surface. The average interest rate, the average negative interest rate for this bank is between 0 and minus 0.75% because it's just a weighted sum of this component and this component here. So what the Swiss National Bank decided at its meeting on March 19th was to increase the threshold factor from 25 to 30. And the aim was to reduce the average negative interest rate burden on commercial banks. So if we look at that, basically what they did was that they increased this gray line, they increased the exemption threshold. If you increase the exemption threshold, the average negative interest rate burden decreases. What does it do? All else equal, a lower negative interest rate burden increases commercial banks' capital and liquidity. And the reason is simple, they just don't have to pay that much negative interest rates to the Swiss National Bank. All right, then let's move on to the liquidity program for the non-financial sector. That was the most important policy intervention by the Swiss National Bank, the Federal Council, and the FINMA, the financial regulator. So on March 25th, the Federal Council announced that it wants to guarantee commercial bank loans to the non-financial sector to companies which were affected by the Covid-19 lockdown up to 40 billion Swiss francs. So there were two portions. The Federal Council guaranteed small loans, smaller than 500,000 Swiss francs, to 100% at 0 interest rate. So that basically meant that every company with a liquidity problem due to the COVID-19 lockdown could just go to their bank, ask for a loan, and they would get the loan because the bank had absolutely no skin in the game whatsoever. If the company defaulted on the loan, the government would cover 100% of the losses. Then there were larger loans up to 20 million, and the government guaranteed these loans up to 85%. So here, the bank had some incentive to check the credit worthiness of the company. The interest rate on these larger loans was somewhat higher, 0.5% on the guaranteed portion. So you actually see on the remaining 15%, the bank was actually free to charge whatever interest rate they found acceptable. So this is a pretty cool program, pretty simple. You just go to your bank, ask for a loan, you get the loan, and your liquidity problem is basically solved. But here's the problem. Granting loans, if a commercial bank grants loans to the non-financial sector, its leverage ratio and liquidity coverage ratio decrease. So there are some regulations out there for bank capitalization and bank liquidity, the leverage ratio and the liquidity coverage ratio respectively, and they both decrease. So that means if a bank faced a binding leverage ratio or liquidity coverage ratio constraint prior to granting the loan, it could not grant any COVID-19 loans. That was a bit of a problem. And just to give you a preview, in order to enable all banks to provide COVID-19 loans, capital requirements were relaxed, the calculation of the leverage ratio was changed, and access to liquidity was facilitated. Well, let's first look at what's happening when a commercial bank grants a COVID-19 loan, or just generally a loan to the non-financial sector. So here's your very stylized commercial bank with some assets on the left and some liabilities on the right. Assets are whatever, stocks, gold, real estate, whatever you can think of, doesn't really matter. And then liquidity is 5. These are the reserves or the liquidity that the commercial bank holds at the Swiss National Bank. Then on the liability side here, this big chunk is basically your deposit account or my deposit account or the deposit account of the company next door. And then there is capital. If you want to compute the leverage ratio, you basically just take the 4, the capital, and divide it by the size of the balance sheet. The size of the balance sheet is 5 plus 30, you can see that here, and you get a leverage ratio of about 11%. If you want to compute the liquidity coverage ratio, it's a very simplified measure. Like the liquidity coverage ratio is some high quality liquid assets divided by some net cash outflows that are expected over the next 30 days and stress. I mean, it's a complicated thing. I'm just simplifying here. And in the simplified version, the liquidity coverage ratio is just 5, the liquidity divided by the size of the balance sheet. Very similarly to the computation of the leverage ratio, we take the liquidity, 5, and divide it by the size of the balance sheet, and you're here, 14%. Now what happens if a commercial bank grants a loan to the non-financial sector? The loan, let's suppose the loan is of size 6. It appears on the asset side and on the liability side of the commercial bank. Excuse me. Why does it appear on the asset side of the commercial bank's balance sheet? It appears on the asset side because it is a claim of the commercial bank against the company, because eventually the company has to pay back the loan. On the other hand, it's also a liability of the commercial bank because the amount of money that is granted in this loan is just credited to the deposit account of that company that asked for the loan. So it appears on the asset side and on the liability side of the commercial bank's balance sheet. So here's your computation of the leverage ratio and the liquidity coverage ratio before granting the loan that we just discussed before. And here is the same after granting the COVID-19 loan. So what you can see now is capital is still 4 up here, and we divide by the new size of the balance sheet, which is 5 plus 6 plus 30. The denominator is bigger, which means that the leverage ratio falls. Similarly, for the liquidity coverage ratio, we take the 5, the liquidity, up here, and divide it by the size of the balance sheet, 5 plus 6 plus 30, and that gives you 12. So you can see both figures fall when a commercial bank grants a loan to the non-financial sector. And that was potentially a problem. Let's suppose that the leverage ratio requirement was, let's say, 10.5%. Then this bank could not have granted this loan here, right? Because the leverage ratio would have fallen to 10%. That is below the requirement. So therefore, the regulator had to do something about it to allow every single bank to grant these kind of loans. Likewise with the liquidity coverage ratio, but I will discuss that later. So let's just look at how they dealt with that potential problem of binding leverage ratios. So initiated by the Swiss National Bank on March 25th, the SNB proposed to the Federal Council to basically lower capital requirements. That is the simplest way you can think of circumventing that problem that I just described, right? Basically, you just say, okay, the leverage ratio requirement is 10.5%, and now it would drop to 10% if that bank was granting that loan. then, well, let's just accept 10% as a leverage ratio. Excuse me. So first step, very obvious, lower capital requirements. Then secondly, that was a very smart move, and it was initiated by the FINMA, which is the financial regulator in Switzerland. It introduced a temporary exclusion of central bank reserves from the calculation of the leverage ratio. So that sounds very complicated, but it's not complicated at all. Just look at the graph once again. Basically, it said, okay guys, when we compute the leverage ratio, we just forget about liquidity. So we have our capital 4, and here I'm making a mistake. Oh no, it's just not written here. Oh, fine. So we take the 4 capital and divide it not by the entire size of the balance sheet, but only by the balance sheet from here to here. We just forget about liquidity. So if we're forgetting about liquidity in computing the leverage ratio, the denominator in this guy here becomes smaller, right? So you're not dividing by 5 plus 6 plus 30, but only by 6 plus 30. This artificially increases your leverage ratio. So basically you go from 11% to 10% if you had included liquidity in the computation of the leverage ratio. Then you forget about liquidity and you go up again to about 11%. So that's a pretty smart move. Compute the leverage ratio without liquidity, and that artificially increases your leverage ratio of that bank. So 2 policy interventions to do away with a potential binding leverage ratio constraint. Then we have the other constraint that may be binding, the liquidity coverage ratio constraint, and that has to do with liquidity. And to solve that problem, to address the problem that some banks may be liquidity coverage ratio constrained, the SNB set up a COVID-19 refinancing facility. And what does it do? What does the COVID-19 refinancing facility do? Basically, it tells banks that if they're granting a loan to the non-financial sector, if they're granting a COVID-19 loan, they could get extra liquidity at a very favorable rate at minus 0.75%. It basically turns the loan into liquidity. That's a bit a sloppy way of saying it. We'll see it just graphically in a minute. But just as a side note, the CRF also incentivizes low liquidity banks to provide COVID-19 loans. So here, what's the deal here? The idea is that low liquidity banks have a marginal interest rate of 0%. They can invest money they get from the Swiss National Bank at 0% on their reserve accounts at the Swiss National Bank. So basically, if they get COVID-19 refinancing loan at minus 0.75%, they can invest that money at 0% at the SNB. And the interest rate wedge is their profits. So the CRF is incentivizing low liquidity banks to provide these COVID-19 loans. But that's just a side note. Let's go back to this thing here. How does the COVID-19 refinancing facility potentially make the leverage coverage ratio constraint non-binding? Well, let's look at this graph. Here I have in dark green, I have the COVID-19 loan and the COVID-19 liquidity. So here is CRF financing. That's the loan that the SNB is granting the commercial bank. So the commercial bank has to pay it back eventually. Therefore, it is a liability of the commercial bank. And the commercial bank is getting liquidity from the Swiss National Bank of the size 6, right? And here the loan of size 6 is just a collateral for this liquidity. It stays on the balance sheet of the commercial bank. Even though the SNB is the owner of that loan, the commercial bank keeps it on the balance sheet because it is the wirtschaftlich Berechtigte. So let's now look what happens to the liquidity coverage ratio, the simplified liquidity coverage ratio. So before granting the loan, it was 5, the liquidity divided by the old size of the balance sheet, which was just 5 plus 30, right? We didn't have the loan and we didn't have the CRF liquidity. Then we moved on to computing, here should be a C, the liquidity coverage ratio. Here's a couple of mistakes actually, but we can get through it. So compute the liquidity coverage ratio after granting the COVID-19 loan. Take the liquidity, 5, here should be a 5, divided by the new size of the balance sheet, which was 5 plus 6 plus 30. 5 plus 6 plus 30 gives you about 10 or 11%, whatever. So it falls. The liquidity coverage ratio falls after granting the loan to the non-financial sector. But then comes in the Covid-19 refinancing facility. So suppose the liquidity coverage ratio regulation required banks to have something like 12% liquidity coverage ratio. Then you can see you fall below that 12% with granting the loan. So how do you do away with that problem? How do you make that constraint non-binding for banks? You just give them the financing through the Covid-19 refinancing facility, give them extra liquidity. Because if you get them extra liquidity, the liquidity coverage ratio changes like that. You take the 5, the liquidity that you had previously, plus the 6, plus the new liquidity you get through the Covid-19 refinancing facility, and divide it by the new size of the balance sheet, which is 5, plus 6, plus 6, plus 30. And that gives you 23%. So it relaxes the liquidity cover ratio requirement or constraint pretty much, or quite easily actually. So that's the Covid-19 refinancing facility. It provides liquidity to commercial banks in order to allow commercial banks, which are liquidity coverage ratio constrained, also to grant loans to the non-financial sector. Let me conclude. The official crisis response of the SNB to the greatest downturn in at least 12 years amounts to first providing US dollar liquidity to the Swiss money market, and then Swiss franc liquidity to the Swiss money market. The first was through US dollar repo operations and through the swap agreement the Swiss National Bank has with the Federal Reserve. And the second one is Swiss franc liquidity through the Covid-19 refinancing facility. Second, the Swiss National Bank decreased the average, but not the marginal negative interest rate. That is, it did not cut in the interest rate target, but it decreased the negative average interest rate burden, and that increased the capital and liquidity position of commercial banks. Finally, it deactivated the countercyclical capital buffer, so that just meant it relaxed the capital requirement of banks. Then, in addition, there were 2 unofficial crisis responses. I believe that the Swiss National Bank is at the moment providing repos, Swiss franc repo liquidity to the Swiss money market to control money market rates. I'm not quite sure of this, but I think they're doing it. And the reason is simple. The Swiss money market rate, for example, the SARON, is rising towards minus 0.65%. That has to do with the change in the exemption threshold potentially. So it's just 10 basis points away from the interest rate target. And therefore, I expect the Swiss National Bank to provide Swiss franc liquidity through repo operations at the moment to the Swiss money market. And second, the Swiss National Bank is defending an unofficial exchange rate floor against the euro. You can just see that from the graph, basically, and correlations between different exchange rates. The Swiss franc was depreciating until mid-March, then it hit about 105, and since then it has stayed there. So the narrow set of actions taken by the SNB during the Covid-19 crisis contrasts starkly with its own decisive steps in previous downturns. I think about interest rate cuts, for example, in 2008, and an explicit exchange rate target in 2011. And it also contrasts starkly with the comprehensive measures taken by other central banks. Here I think about forward guidance, for example. It's done by the Federal Reserve Bank, it's done by the ECB, and I also think about the Fed's the Fed is trying to push down risk premia on corporate bonds at the moment. That's like a big issue in the US at the moment. The Swiss National Bank is not doing anything like that. So basically, the official crisis response, and that's your take-home message, of the Swiss National Bank is limited to relaxing capital and liquidity regulations in order to allow constrained banks to provide credit to the non-financial sector. All right, let me add some advertisement. It's really some advertisement. If you're into the SNB, if you like to read more about the SNB, check out my homepage here. I have some pretty wonkish articles about the SNB, about the monetary policy concept of the SNB, some new ideas for conducting monetary policy in Switzerland, some critiques, some news. Just go through it, read it, give me some feedback. I will be glad to hear what you have to say. And with that, I would like to close the talk and thank everyone who gave me feedback on my previous version of this talk. And I wish you a pleasant day. Thank you.